Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the bullish scenario where we are looking for an impulsive structure to the upside, either in a regular impulse 1, 2, 3, 4, 5 or a bigger contracting diagonal. Now the most common target for your wave 2 is the 0.5 to the 786 Fibonacci, taken from the low of 1 to the high of wave 1, giving you a target area between 63.4k and 61.2k. Important in this scenario, however, is the 886 that you see over here, taken from the high to the first low that we made. The 886 is touched and therefore the probabilities decrease for this move to the downside to be impulsive and increase for this move to the downside to be a wave C or Y. Reason is that the 886 is a very rare target for a wave 2, common target for a wave B or a wave X, increasing the probabilities that this move to the downside is a wave C or Y, which therefore in turn increases the probabilities to sooner or later move towards the upside and take the highs. It has to be said though that we got very close to the golden pocket over here, as you can see, but we just missed out on hitting it. And it is quite uncommon for price to get this close to the golden pocket but not actually hit the golden pocket. And I also have a target box here because we do have some more confluences in this area between 62.2k and 62.6k, and to the upside we have the first area of resistance here, 65.4k to 65.8k. On the 15-minute time frame, the bullish scenario is that here your low is in and you're looking for a zigzag to the upside in an ABC, where this resistance is very interesting, after which we want to see price move to the downside and test this support, or you're looking for an impulse in a 1, 2, 3. Now, because the weekend is coming up, probabilities for a wave 3 are not really high, so because of the weekend, actually an ABC would have a higher probability. But by all means, we are looking for a 5, 3 and then a continuation to the upside to take the high of A or 1. The corrective structure to the downside here is then a zigzag A, B, C, 5, 3, 5, where the corrective structure in this wave B with the news is counted as a flat in an A, B, C before then the second leg down, this wave C here. Common target area for your wave C is between the 1 and the 1.236, taken from the high to the low of A to the high of wave B, which as you can see is nicely respected. And also this low is made before the 3 fib time, which is taken from the low to the high of A or 1, which is also what you prefer to see. Now in this scenario, we then want to see continuation towards the upside. The bearish scenario on the 1 hour time frame is an impulsive structure to the downside. So instead of a corrective structure, we're now looking for an impulsive structure in a wave 1 or a wave A. 1, 2, 3, 4, 5, low already in, or potentially 1, 2, 3, sideways 4 and a 5. And then we look for a bounce towards the upside in a wave 2 or B, before then continuation to the downside in a wave 3 or C to take the low that we have over here. Then again, the 886 that I have on my chart here plays a very important role with regards to the probabilities because, as mentioned, this is a rare target for a wave 2, which therefore decreases the probabilities that this structure to the downside is an impulsive structure, and that is exactly what we actually need in a wave 1 or A. We need this to be an impulse to the downside, but just because of the 886 touch, the probabilities for that are decreased, which then in general decreases the probabilities for this particular scenario. Now the invalidation is very clear. That is price moving towards the upside and taking the high. The more local bearish scenario is that we have a flat structure here, ABC, and we are looking for a move towards the downside to test that interesting golden pocket area here, the area of confluence. Very, very interesting indeed. Now there's 3 scenarios that we have to keep in mind. If this is an ABC to the upside and this is the end and we look for an impulsive continuation to the downside to test support, we have to think about an impulse, a diagonal, or a double 1, 2. Now in an impulse, we're looking for 1, 2, 3, 4, 5, preferably no overlap between 1 and wave 4, but as you can see, lots of overlap over here, so that doesn't have great probabilities, right? That is invalidated, which therefore means we have to look at the diagonal or the double 1, 2. Now in a diagonal structure, we are then looking for a wave 1, 2, 3, 4, and eventually a wave 5. However, this one is already invalidated because in a wave 2, if this is your 1, 2, 3, 4, 5, wave 2 and wave 4 in a diagonal are only allowed to be zigzag structures, and this wave 2 over here is not a zigzag structure, as we are counting this as a flat. So therefore, a diagonal structure would be a wave 1, 2, 3, 4, 5, which means that throughout the weekend we could then see some sort of a grind ranging type of structure to the downside, hitting the support, ranging here for a little bit, maybe take the lows then next week, and then move towards the upside. That would be the highest probability diagonal scenario, at least the highest probability bearish scenario, seeing some sort of a diagonal where you then have a zigzag in 1, looking for a zigzag in 2, zigzag in 3, in 4, and eventually in 5, hitting support, moving to the upside. The most bearish scenario would be a double 1-2, 1-2, 1-2, and a very big impulsive move towards the downside. However, because this move here is already extended in then a wave 3, it decreases probabilities for a wave 5 to also be extended. And if this is a 1-2, 1-2, and we look for a big 3, wave 5 is going to be extended. That's not really what we want to see. And of course, the weekend is coming up, and generally during the weekend, we don't see wave 3s. Now, we did hit support earlier today in the live stream. I put 2 red lines on my chart. It's actually pretty brilliant to see these acting as support. These are small point of controls of this area over here, causing a little bit of a move towards the upside. But as mentioned, the next area of support, very interesting, 62.6, 62.2K. And actually below that, we also have this red line here, 61.1K, which is also a point of control of this range here on the left, right? So we do have some areas of interest, but mainly the blue box over here. If we look at the CVD divergences, then we have both bullish and bearish CVD divergences. Higher low in price, lower low on the CVD, and also here more locally bearish, lower high on price, right? Higher high on the CVD. I think I said it wrong here. Higher low in price, lower low on the CVD, of course. Now, what it looks like on the chart, 15-minute time frame here, is a higher low in price, as you can see on yellow, higher low, but then on yellow, lower low on the yellow CVD line, a bullish CVD divergence, but then locally, lower high on price, higher high on the blue CVD, a bearish CVD divergence. Now, because these two are contradicting, right, it's not easy to read it. Generally, the first divergence that appears has the highest probability of playing out, and that is why this one over here is not too interesting to me. However, the ones that are going to be very interesting to me are the small ones on the 3-minute time frame, because as price moved down here, we did see on the 3-minute time frame some bearish CVD divergences, and that was over here on the 3-minute before this red candle to the downside, lower high on price, but look at blue here, higher high on the CVD, bearish CVD divergence, right? Now, if price continues grinding towards the downside here and continues to create these small 3-minute bearish CVD divergences, even though on the 15 we may have bullish CVD divergences here, those 3-minute bearish CVD divergences to me are more important than the zoomed out 15-minute ones. So at the moment, this one would have a higher probability because it appeared first compared to this red one, but the small ones, if we continue to see price grinding to the downside, creating bearish CVD divergences, these get a priority, and I would be looking for price to take the lows. If we then look at the probabilities of the different scenarios, then on the weekly time frame, the probabilities not covered in this particular video are higher for the bullish scenarios, where we see a continuation of the trend, compared to the bearish scenarios. On the 1-hour time frame, which is the time frame where we are on right now, we are looking for a bounce either way, either directly to the upside or moving to the downside and then to the upside to touch that golden pocket, which is oh so common, as it is so uncommon to actually leave it hanging, right? So either directly or hit support and then move towards the upside. On the 15-minute time frame, generally, when we look at the scenarios that we shared here in the respect, the bullish scenario does look a little bit better. But if we continue to see a 3-minute bearish CVD divergences here, the downside increases in probabilities to test this support. Now, the overall probabilities here, looking for a local bounce, either directly or first hit the golden pocket and then see a bounce towards the upside. I hope that this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.